Let's bring in our market panel. Joining us now, BD8 Capital CEO Barbara Doran and Evans May Wealth Managing Partner Brooke May. Good to see both of you. Barb, I know that you've been watching healthcare. You're interested in it. I just mentioned Intuitive Surgical. They're not, all the healthcare names aren't moving exactly the same. So how do you play it in this market?
Well, in the healthcare, it's interesting because healthcare, cyclicals, value, small cap, we're all running, and people are looking right now for the laggards. I think you've got to stick with names. I mean, I'm a growth investor, that really have good growth pathways. And even, for instance, an Eli Lilly, which has tremendous market opportunity, I think is still not too late to buy it. You're going to continue to see earnings going up. Or United Healthcare, which is a core holding in my portfolios, has really done nothing. There's been concerns about high utilization and costs, and yet if you take the longer run picture, they are one of the best business models in the business. So I think you have to continue to look for good names, high quality, that have not performed or lagged for various reasons, like UNH. And those things, when you look at the steps they're taking, they will do well.
Okay, and Brooke, we get the first wave of bank earnings Friday morning. That means one more trading day to prepare. You say not to trust any overall rally off of these levels. Why?
We do think in the short term, there could be some opportunities in banks. They're cheap, but they're cheap for a reason. The economy, though, wasn't as bad as expected in the fourth quarter, and losses from our reduced earnings expectations from last year are already baked in. So we think there could be some near-term upside earnings surprises when it comes to the banks, but there are regulatory issues that linger, and until we have more clarity there, we're hesitant to buy banks for the long term.
So, Brooke, I'm looking at your, outlook here for 2024. S&P 500, you expect to end in positive territory this year. Bottom up target price of 5,200 to 5,400. What's actually going to power us there? Is it going to be unexpected, maybe not fully priced in earnings growth as we do go through the year? Is it going to be the Fed cutting rates? Is it going to be something else?
All of the above, but really earnings. The market trades off of earnings, and we think earnings will be higher than expected. As we all know, the consumer has been incredibly resilient. Unemployment has stayed very low, and so consumers are going to spend, and that's going to bode well for earnings next year, in addition to interest rate cuts. We're in the camp, though, that the Fed is going to be patient. We think that 6 or 7 cuts is unlikely. It might be 3 or 4, but coming really towards the second half of the year. If unemployment stays low, there just isn't that urgency to start cutting rates. And so if unemployment stays below 4.1%, which is what the Fed is expecting for next year, we think that it might be the middle of the year before we see the first rate cut.
Barbara, how are you thinking about it, especially the rate cut piece of this? I mean, we just got commentary from another Fed official, Williams, last hour, and he basically said that restrictive policy will likely need to continue for some time. That doesn't sound like a huge flurry of rate cuts in the cards. How much matters in terms of CPI data we get tomorrow and some of these other key readings?
Yeah, well, it's interesting. I think you're going to hear continual talk from different Fed officials just trying to keep the market under control. I think the CPI number and the PPI number, the wholesale number due on Friday, are going to be important, not because, everything hangs on 1 or 2 numbers, but I think it could be helpful in terms of the timing of the Fed rate cuts. As Brooke said, the Fed is not in a hurry to cut rates. We don't see a recession in sight. The economy has been, to use the word everybody's using, is very resilient. Things are moderating. We're seeing this in all sorts of ways in consumer spending, et cetera. But basically, things are holding up. So I think if the number, for instance, comes in lower than expected, that could mean inflation is coming down more than expected, because the Fed will cut rates aggressively if, 1, things are really tanking quickly. We don't see that. Or 2, inflation is coming down much faster than they expect, in which case you don't want to leave the real rate too high, because then that will become restrictive. And we've already seen what happened. We know what's happening in manufacturing. There's a recession there. We've seen what's going on in housing. But if you look at just the slight decrease in the 30-year mortgage rate, you saw the numbers this morning. It averaged 7% last year, 8% high in October. Now it's 6.8. And you saw a big weekly jump up in refi applications, mortgage applications, new home sales. So interest rates are having a powerful effect. But I don't think the Fed is in a hurry. But tomorrow could change their timing a little bit, depending, if the number is better than expected, meaning lower.